Everyone is watching AI chips, but investors may be missing the companies that make those chips usable. A data center can buy the most advanced GPU in the world, but it still needs power to run it, equipment to distribute that power, and cooling to keep it from overheating. That is why Vertiv, Eaton, and Quanta Services are attracting attention. The real question is not whether AI needs more power. It does. The question is which stock still offers a reasonable risk-to-reward trade-off after the rally. In this video, we will compare Vertiv, ticker VRT, Eaton, ticker ETN, and Quanta Services, ticker PWR. We will cover what each company actually does, the latest numbers, the AI opportunity, and the risks investors should not ignore. Then, we will finish with a simple buy, wait, or avoid framework. This is not about chasing the next AI headline, it is about understanding what is already priced into these stocks. The latest catalyst is straightforward. Demand is appearing in reported results. Vertiv reported first quarter revenue of $2.65 billion, up 30% from a year ago. Adjusted earnings per share rose 83% to $1.17. For 2026, the company guided for revenue of $13.5 to $14 billion and adjusted earnings per share of $6.30 to $6.40. Eaton reported record first quarter sales of $7.5 billion, up 17% year-over-year. Adjusted earnings per share were $2.81. In Electrical Americas, data center orders rose approximately 240% from the prior quarter comp-sip, while data center revenue increased about 50%. Quanta reported first quarter revenue of $7.87 billion, up 26% year-over-year. Adjusted earnings per share rose from $1.78 to $2.68. Its total backlog reached a record $48.5 billion. So, the AI power story is supported by real business results. But these are not three versions of the same company. They sit in different layers of the infrastructure chain. Think of the AI data center as a factory. First, it needs enough electricity. That is where Quanta Services matters. Quanta designs, installs, repairs, and maintains electric infrastructure for utilities, power generators, large load customers, and communications operators. In plain English, it helps build the transmission lines, substations, and electrical systems that bring power closer to major projects. Quanta does not need to sell cooling equipment to benefit from AI. It benefits when customers need new grid capacity, faster interconnections, and infrastructure for large data center loads. Next comes Eaton. Eaton sells electrical equipment used to control, protect, distribute, and manage electricity. It has data center exposure, but it also serves utilities, industrial facilities, commercial buildings, aerospace, and mobility. It recently added Boyd Thermal, expanding its cooling capabilities and strengthening its grid-to-chip story. Then comes Vertiv. Vertiv is the most direct AI data center play of the three. It sells critical power systems, uninterruptible power supplies, power distribution equipment, liquid cooling, racks, and services. If Quanta helps get power to the site and Eaton helps manage and distribute it, Vertiv helps the data center operate reliably once the equipment is inside. That direct exposure creates the highest upside. It also creates the highest expectations. Now, the numbers investors should focus on. For Vertiv, 30% revenue growth and 83% adjusted earnings growth are exceptional. But after a major stock move, investors should ask a harder question. Can results keep exceeding already high expectations? A company can beat earnings and raise guidance, yet the stock can still fall when investors expected an even bigger surprise. That is the central risk with Vertiv. Eaton's story is more balanced. Total sales grew 17%. Electrical Americas sales rose 20%, while orders were up 42% on a rolling 12-month basis. Backlog in that segment was up 44% year-over-year. Eaton also generated $507 million of operating cash flow and $314 million of free cash flow in the quarter. For the full year, management guided for $3.9 to $4.3 billion in free cash flow. That does not make Eaton automatically cheap, but its business is broader and cash generation is an important advantage for long-term investors. For Quanta, the $48.85 billion backlog is the headline number, but backlog is not revenue, and revenue is not free cash flow. Still, Quanta reported $184.4 million of first-quarter free cash flow and raised its 2026 outlook. Management expects revenue of $37.7 to $35.2 billion and adjusted earnings per share of $13.55 to $14.25. The key question is execution. Can Quanta turn that backlog into profitable projects without material delays or cost pressure? Here is the simplest comparison. Vertiv is the direct AI power and cooling winner. Its upside is tied most closely to higher density AI racks, liquid cooling, and data center buildouts. If AI spending remains strong and technical requirements keep rising, Vertiv has the most direct operating leverage, but it is also most exposed if hyperscaler spending slows or the market decides the growth is already fully priced in. Eaton is the broad electrical quality play. It has meaningful data center exposure, especially in Electrical Americas, but it also has aerospace, utility, industrial, and commercial exposure. It's less of a pure AI bet and more of an electrification platform with an AI tailwind. Quanta is the grid bottleneck play. It benefits from the reality that power demand is not solved with a purchase order for GPUs. New load often requires transmission upgrades, substations, engineering, skilled labor, and permits. That gives Quanta a durable long-term thesis. It also makes it dependent on project execution. So, this is not a contest to find one winner. It's a question of which risk you want to own. The bull case has four parts. First, AI infrastructure is physical. High-density data centers need steel, copper, transformers, switchgear, backup power, cooling equipment, and skilled labor. Those are real bottlenecks. Second, the demand signal is broad. Vertiv is growing rapidly in critical power and cooling. Eaton's data center order growth is accelerating. Quanta has record backlog and raised guidance. Third, these are not early-stage cash-burning AI stories. All three are profitable. Eaton and Quanta are producing meaningful cash flow, while Vertiv is producing rapid earnings growth. Fourth, the spending cycle may last longer than a single quarter. Grid upgrades, new data center campuses, electrical systems, and cooling installations are multi-year projects. That can make this theme more durable than a short-term AI headline. Now for the bear case. First, valuation and expectation risk. Vertiv and Quanta have delivered strong stock performance. Great businesses can still become expensive stocks. When expectations are high, the market does not reward good results. It rewards results that are better than what is already priced in. Second, AI capital spending can slow without collapsing. Hyperscalers do not need to cancel every project for these stocks to react negatively. A delay, slower ramp, or cautious spending outlook can be enough to compress valuation multiples. Third, these stocks are more correlated than they appear. Owning VRT, ETN, and PWR may look diversified, but all three depend on some version of the same thesis: continued electricity demand, AI data center construction, and infrastructure spending. Finally, execution matters. Quanta faces project, permitting, weather, labor, and supply chain risk. Eaton must convert record orders into revenue while protecting margins. Vertiv must meet high expectations while managing competition and the possibility that large tech companies build more capabilities in-house. AI may be a multi-year theme. That does not mean these stocks move in a straight line. For retirement and long-term investors, the portfolio question is as important as the company question. If you own an S&P 500 fund, an industrial ETF, or a large-cap growth fund, you may already have exposure to these names. Vertiv joined the S&P 500 this year, and Eaton and Quanta are also major large-cap holdings. For a 40-year-old investor with a long time horizon, VRT or PWR may fit as smaller satellite positions, assuming the rest of the portfolio is diversified. For investors closer to retirement, Eaton may be easier to own as a broader electrical and industrial business, but none of these stocks should replace broad diversification. The mistake is not owning one of them. The mistake is treating VRT, ETN, PWR, NVIDIA, data center real estate, and an S&P 500 fund as unrelated positions. They are not. So here's the final buy, wait, or avoid framework. Vertiv, wait. The business is excellent, and the AI cooling opportunity is real, but it has the highest expectations in this group. A disciplined investor may wait for either a better valuation setup or further earnings growth that proves the market is still underestimating the business. Eaton, buy candidate, but do not chase. Eaton is the most balanced business in this comparison. It offers AI data center exposure, grid-to-chip power management, cooling, and broader electrification demand. For a long-term investor, it is the closest thing here to a core quality candidate, but position size and entry discipline still matter. Quanta, wait, with a long-term watchlist bias. The backlog, raised outlook, and grid bottleneck thesis are strong, but Quanta is execution sensitive and priced for future success. A record backlog does not eliminate project risk. And avoid this mistake, buying all three at once, because AI needs power. That is not a diversified decision. It's one concentrated bet expressed through three tickers. The non-hype takeaway is simple. AI needs more than chips. It needs electricity, infrastructure, and cooling. Vertiv is the direct AI infrastructure leader. Eaton is the broader electrical quality play. Quanta is the grid bottleneck winner. But the best business is not always the best stock at today's price. Before making any investment decision, review your existing ETF and retirement account exposure, your time horizon, and how much AI concentration you already own. This video is for educational purposes only, not financial advice. Which one would you choose today? VRT, ETN, PWR, or none of the above? Let me know in the comments.